What you're watching unfold in silver right now is not a rally. It's not speculation. And it's not a bubble. It is the final stage of a collapse pattern that has already played out again and again and again throughout history. And every time this pattern completes, the outcome is the same. The paper market dies, and the physical price explodes. Most people never see it coming because they're staring at charts. But collapses don't start on charts. They start in vaults. The illusion everyone believes. And for decades, the global silver market has operated on a promise that paper silver and physical silver are interchangeable, that a futures contract is as good as metal, that an ETF share equals ounces. That promise only works when almost nobody asks for delivery, because the entire system is built on fractional reality. For every single ounce of real silver, there are dozens, sometimes hundreds, of paper claims, 50 to 1, 100 to 1, in some cases more. And as long as confidence holds, that leverage stays hidden. But history shows us something brutal. When trust breaks, paper claims don't get redeemed, they get tested. The four-stage collapse pattern. Every paper commodity collapse follows the same 4 stages, no exceptions. Different centuries, different metals, same outcome. Stage 1, the setup. A paper market is created: futures, forwards, derivatives. The pitch is always the same: liquidity, efficiency, price discovery. Physical delivery becomes optional, convenient, unnecessary. This is how leverage enters quietly. Stage 2, overextension. Paper claims multiply, not by accident, by design. Banks sell what they don't own. ETFs issue claims backed by allocated later. Exchanges assume delivery will never be demanded at scale. The system works only because most participants never ask for metal. This is where silver has lived for decades. Stage 3, awakening. This is where we are now. A shock hits the system, not just economic, geopolitical, monetary, trust-based. Suddenly, major players stop trusting paper. Nations, sovereign funds, industrial buyers. They don't want exposure, they want control. So they do the unthinkable. They ask for delivery, and the moment that happens, everything changes. Stage 4, collapse. This stage always looks chaotic because the exchange faces an impossible choice. Either deliver metal it doesn't have, or cash settle contracts and admit the paper price was fake. Both outcomes kill the paper market, and once the paper suppression mechanism is gone, the physical price doesn't drift higher, it reprices violently. This has happened before. This is not theory, it's documented history. In 1968, the London gold pool collapsed when physical gold drained faster than central banks could supply it. In 1933, the United States defaulted on the gold clause, confiscating metal because the paper promises couldn't be honored. In 1720, the Mississippi bubble collapsed when paper claims overwhelmed real assets. Different eras. Same math. And silver is now following that exact blueprint. The 2-tier market has already formed. This is the part most people miss. The collapse doesn't start with default. It starts with 2 prices. One price on the screen, another price in the real world. Right now, paper silver trades around $78 on Western exchanges like COMEX. Physical silver commands massive premiums, delayed delivery, restricted access. And in Asia, it's treated as strategic inventory, not a trade. The Shanghai-Dubai corridor. This is the axis that changes everything. Silver is being drained from Western vaults and shipped east, Shanghai, Dubai, Middle East. Once silver enters this corridor, it doesn't come back. It's not leased. It's not rehypothecated. It's locked away. China views silver as industrial infrastructure. The Middle East views it as strategic reserve. This is not speculative demand. It's permanent removal. The drain is real. In the last 18 months alone, 379 million ounces of silver have been removed from COMEX vaults. That's not rotation, that's extraction. Registered silver, the metal actually available for delivery, has been collapsing, and COMEX was never built to survive this. The math nobody wants to do. COMEX is designed for 3% delivery rates, that's it. But now, delivery requests are pushing 15 to 20%. Let's do the math. Registered inventory, approximately 194 million ounces. Open interest represents over 950 million paper ounces. If just 20% stand for delivery, the vaults are empty. There's no if, only when. Why this isn't a speculative squeeze. This isn't retail hype. This isn't meme trading. The buyers draining silver right now are sovereign, industrial, strategic. They don't flip positions. They don't trade momentum. They don't care about RSI. They care about supply certainty. And once they take delivery, that metal is removed from global circulation forever. The structural deficit makes this worse. Even without investment demand, Silver is already broken. Annual mine supply, roughly 800 million ounces. Annual industrial demand, over 1.2 billion ounces. That's a 400 million ounce deficit every single year. That gap is filled by above ground stocks that are now disappearing. Add investment demand to that, the system snaps. Why the paper price is still low. People ask, if this is real, why hasn't price exploded yet? Because the paper market still exists, barely. It's suppressing price by issuing claims faster than metal can leave. But suppression only works until the vaults hit zero. Then the price doesn't rise gradually, it resets. Where this is going. Once COMEX defaults, either through cash settlement or delivery suspension, trust is gone. The paper price is ignored. The physical price is set by whoever has metal, and that price will be set by the Shanghai Dubai bid, not New York. Why $120 is conservative. At $120 per ounce, silver would still be cheap. The gold-silver ratio remains distorted. Historical average, 60:1. Geological ratio, 17:1. At even mild compression, silver triples. And that doesn't account for permanent deficits, strategic hoarding, industrial desperation. This is not about getting rich. This is about not being erased. Paper silver is a promise. Physical silver is possession. And in every systemic reset in history, promises break. Possession survives. We are now standing at the edge of stage 4. And once the final drain completes, there is no rewind. Everything you've ever heard so far leads to one unavoidable question. What actually happens when the paper market breaks? Not in theory, not on Twitter, but in the real world. Because when COMEX fails, it won't look like a headline. It will look like silence. How the default actually happens. People imagine a dramatic announcement. They imagine alarms. They imagine a press conference. That's not how this works. The paper market dies quietly. It begins with something small. A delayed delivery, a temporary cash settlement, a force majeure clause quietly invoked. The exchange will say, due to extraordinary conditions, contracts may be settled financially. And in that moment, the illusion ends. Because the contract was never about money. It was about metal. Cash settlement is a default. Let's be absolutely clear. If you buy silver and are paid cash instead of metal, that is not settlement. That is failure. It means the exchange promised something it couldn't deliver. And once that happens, no industrial buyer trusts futures, no sovereign accepts paper claims, no ETF price matters. The paper price becomes irrelevant. What happens? The same week. The moment delivery confidence breaks, premiums explode, not slowly, instantly. You won't see 5% premiums. You'll see 30%, 40%, 50%. And availability won't tighten gradually. It will vanish. Dealers won't quote prices. They'll quote availability. Out of stock. Delayed. Allocation only. This is what happened with nickel, with palladium, with energy markets. And silver is next. Why the price will gap, not climb. Most people expect price discovery to be orderly. It won't be. When suppression ends, price doesn't walk up the stairs. It teleports. Because years of artificial selling have compressed value. When the paper lid comes off, the spring releases all at once. That's why $120 isn't aggressive. It's mathematical. Why industrial buyers, testet, do not care about price. This is the part retail investors Don and T understand. For an industrial user, silver is not an investment. It's a requirement. Solar panels don't function without it. EVs don't scale without it. Electronics don't exist without it. When supply is threatened, price becomes secondary. Factories pay whatever keeps production running. That's how shortages behave. The gold-silver ratio will collapse. Right now, the ratio is distorted, historically wrong. In every precious metals reset, gold moves first, silver follows violently. Not because silver is better, but because silver is thinner. It takes less capital to move the silver market. That's why in past resets, silver didn't just catch up, it overshot. Why paper holders will be trapped. ETF holders believe they own silver. They don't. They own claims. In a delivery failure, ETFs settle in cash, futures settle in cash, options expire worthless. Meanwhile, physical holders watch premiums detach from spot. Two worlds, two outcomes. Why waiting for a dip is a trap. Everyone wants confirmation, everyone wants a pullback. But in a physical crisis, there are no clean entries. There is only available or unavailable. By the time price confirms, inventory is gone. Why this is bigger than silver? Silver is not the end game, it's the signal. This is about the end of paper-based trust systems, energy, metals, currency. We are moving from promises to possession, from leverage to control. Silver is simply the weakest link. what you should be watching. Right now, not charts, not influencers. Watch registered COMEX inventory, physical premiums, delivery delays, cash settlement language. When registered inventory drops below 150 million ounces, the system is unstable. Below 100 million, default is imminent. This is not an investment call. This is not about profit. It's about insurance. Insurance against supply chain failure, currency debasement, contract failure, counterparty risk. Paper can T-insure you against paper failure. Only metal can. The choice is binary. When the break happens, there will be no middle ground. You will either hold a promise or an element, a claim or control. History shows which one survives. Final thought. Every major collapse looks obvious in hindsight. People will say, the signs were there. We should have seen it. It was inevitable. And they'll be right. But inevitability doesn't help you if you act too late. Silver is not running out. It's being removed. And once the vaults are empty, no amount of money brings it back.